Matthew, thanks for joining. We're here to have a good conversation about some paper analysis that you've written. So I want to just start off by introducing myself, the two Matts from the Bitcoin Policy Institute. Yeah, I think we're going to be recruiting more Matts as we go along. So we got a solid contingent here. So Matt Pines, for those that may not be aware, so I'm a national security fellow at the Bitcoin Policy Institute. My day job is as the director of security intelligence at a cybersecurity and geopolitical risk analysis firm. I'll turn it over to Matt to introduce himself.
Yeah, so I'm a Ph.D. candidate in economics at Harvard University.
Excellent. So Matt, before we kind of dig into some of the recent research that you've put out, I just want to kind of step back, like your background, why you kind of got into economics, and sort of your academic and intellectual journey to date.
Yeah, so before doing economics, I actually did 2 engineering degrees at Stanford what Stanford calls it management science and engineering. It's basically industrial engineering and operations research. Also did the economics minor there, and I really enjoyed thinking about kind of the big problems that people ask in economics. And also enjoyed working on, it's consistent with my engineering background, working on problems that have sort of real world applications, sort of policy implications, that kind of stuff. So when I went to graduate school in economics, which I really liked the structure of it, because compared to like the physical sciences or engineering, you're generally not going to be in a lab. Like you're going to be kind of having a lot more freedom to decide what exactly it is you like and what you want to work on. And you can also, your interests may change over time. So having that flexibility was nice. And I think at the graduate level, economics uses a lot of the same methods and models that people use in engineering. They just apply them in kind of a different setting. So I've enjoyed that, and thinking about kind of what are the problems out there that are interesting that haven't been written about so much.
What particular kind of areas of focus have you sort of delved into in your graduate studies?
Yeah, so I've done more kind of applied macroeconomics and international finance. So for the paper that we'll be talking about today, I kind of came at it from actually not so much the cryptocurrency angle, but more from the sanctions angle. So I was interested in trying to understand what the effects of sanctions might be on the international financial system, and kind of related to that was sort of this question of, okay, if you care about this type of risk, you want to try to protect yourself from it or reduce your exposure to it, what can you do? And I mean, one of the things you could do is buy a lot of gold and keep it kind of stored in your own vaults where you've got control of it. But there's also these new, relatively new, digital currencies and digital assets that are not really under the control of any particular government, and so that makes them interesting from this standpoint, and that's kind of how I began building out this project.
Excellent. So that's a good segue to talking about the paper. So called hedging sanctions risk, cryptocurrency and central bank reserves. So I think it'd be helpful just to have you kind of walk through kind of the structure of the paper, kind of from your kind of methodological approaches. We don't need to get too technical, but kind of give a sense of the analytical framework that you brought to bear on this sort of geostrategic question, and how you sort of went about doing some of the modeling and any kind of the uncertainties and parameters that we need to kind of be aware of to think about how to draw some of the implications.
Yeah, sure. So basically, the paper is divided into 2 chunks or 2 parts. The first part is looking at gold holdings, like what central banks are doing with their gold holdings, because as I think I just mentioned, gold is one of the few things you could buy where if you've got sort of physical custody of it, it is potentially one way of helping to protect yourself against this type of sanctions risk. We see, for example, that Russia, prior to its invasion of Ukraine, actually significantly increased the gold share of its central bank reserves, up to, I think, almost a quarter of its reserves, which that's roughly twice the global average. So, they definitely understood this, and they also knew to store their gold in Moscow and St. Petersburg, not in the New York Fed, where the New York Fed obviously will be able to enforce sanctions on the gold that's stored there. So I'm looking at these gold holdings, and I want to relate it to a variable that I think is a proxy for the risk of sanctions. I can't compute that or estimate that exactly. Like I just don't know of a way to compute, like what's country X's risk of facing sanctions. So instead, what I do is I say, let's find something that's probably correlated with it. And the best thing I could come up with that was where do you get your military imports from? So if you get a lot of your military imports from China or Russia, it seems plausible that you're going to face a higher risk of sanctions than if you get more of them from the United States, at least as far as the risk of U.S. sanctions. The U.S. obviously cares a great deal about the military activities of China and Russia, and actually over the last few years has specifically created or stepped up sanctions programs that target them. So it seems like a good proxy. And I find that countries that got more of their military imports from China and Russia between 2016 and 2021 actually did increase the gold share of the reserves at a faster rate than countries that got more of those military imports from the United States. And now I can't necessarily rule out that this could be explained just by political considerations. Like it could be that the countries that are getting more of their military imports from Russia and China just find it distasteful to hold U.S. treasuries because they don't like the politics of the United States. So they may not necessarily explicitly be considering this risk of sanctions, but at least it is interesting that the evidence is pointing in the direction that countries that are more aligned with Russia and China are kind of bulking up on their gold reserves. Some newer evidence just from the last couple of quarters where China's central bank was also making some pretty big gold purchases. So, the gold is definitely a thing. It's not going away, and so thinking about like who's buying that is interesting. So that's the first part of the paper. The second part of the paper is kind of more of a simulation and kind of mathematical modeling exercise where I want to answer the question of how much does the risk of sanctions actually affect kind of the optimal central bank reserve portfolio? If I change the risk of sanctions by a little bit, does it have a big effect on that, or does it have a small effect? If the effect is small, then maybe this isn't something that you would think would have a big effect on the international financial system, and so it's maybe not really worth spending a lot of time thinking about. But if the effect is large, then that says that kind of the potential overuse of sanctions may have some pretty negative consequences for the U.S. in terms of disincentivizing countries from holding U.S. dollar reserves because they fear these sanctions potentially being applied to them. So I estimate this econometric model where I look at the volatility and the returns of five major reserve assets. So I look at treasuries, eurobonds, kind of a global stock index, gold, and this candidate asset, Bitcoin, which I treat as being kind of representative of the non-stable coin cryptocurrency space. I mean, Bitcoin is already a majority of that, and Bitcoin and Ether combined are like a pretty significant majority of the total market capitalization of cryptocurrency. So it's kind of a way of just being a proxy for kind of digital assets that are difficult to sanction. And so once I've got this model of their returns and their volatility, where, by the way, I do one thing that I think is important is I make a correction for Bitcoin. You can't just estimate a model that's based on the historical returns of Bitcoin because those have been really good, right? Like in the last 10 years, Bitcoin's gone from, I don't even know, like $10 to 20,000. So if you're just kind of projecting that forward, Bitcoin's going to look like the best thing since the best thing ever. I mean, like you'd want to invest everything in an asset that's going to, multiply thousands of percent returns every 10 years. So I make a correction for that, and I basically adjust the future expected returns of Bitcoin much closer to inflation. So thinking about Bitcoin is kind of like gold in that sense, that it has a real return that's going to be somewhere in the vicinity of inflation, maybe a little bit above. There are some reasons to think that Bitcoin is maybe a little bit more scarce than gold. So then with that model being estimated, I can draw simulations from it, which are kind of representative of what like a 3-month series of returns of these assets might be, and then put that into an optimization framework where I say, okay, like here's a mean variance criteria, and let's optimize a portfolio here based on these assets. But let's do it with one other thing, which is this risk of sanctions. So I have this variable in there that's the risk of sanctions that are where I'm looking at the U.S. and the Europeans. I assume that they are correlated, and that the U.S. sanctions risk is a little bit higher than the European sanctions risk, which seems to be reasonable. I mean, the U.S. has been more aggressive in general with sanctions than the Europeans, and also for the Europeans to implement sanctions, you need unanimous consent among all the European Union countries. So it seems reasonable to think that that's harder to get everybody to agree on than just getting the U.S. president to sign off on something, which is really all you need for U.S. sanctions to be implemented. So I find actually that the optimal portfolio is quite sensitive to this risk of sanctions, and even a 1 in 100 risk of U.S. sanctions in a 3-month period generates an optimal portfolio that's around 50% in gold, and then maybe like 5-ish or so, 5 to 10 in Bitcoin, just depending on the central bank's risk tolerance. So gold definitely comes across as kind of the primary or preferred way to hedge this type of sanctions risk, because it's so much more stable than Bitcoin. But nevertheless, the fact that Bitcoin is this digital asset, which makes it kind of interesting, maybe easier for some central banks to hold on to if they don't have vaults or security infrastructure where they'd be able to transport and secure large amounts of gold, and also Bitcoin is not all that correlated with all these other assets. So you do get a little bit of diversification benefit from that, but yeah, I'll stop here.
No, that was a great summary. Kind of want to peel the onion a little bit before we get to maybe the Bitcoin nuances, just on the gold sanctions risk. So one thought that I had in reviewing the paper is potential confounders with geopolitical risk in general. So sanctions risk, you could argue, is a function of geopolitical risk in the sense that states' competition, becoming more fraught, is likely to raise the probability that a state is going to sanction another state.
Right.
But there might be other motivations for moving to gold and its traditional kind of sort of hedge as like a geopolitical risk-off asset. So how do you think about disentangling that in terms of the data that you sort of modeled there? Obviously, military purchases, right, would be like that's an indicator of geopolitical alignment that you have in the paper, but also military purchases you would do in advance of maybe, an expectation that the geopolitical environment's going to be more risky. I think during the Cold War, like the average GDP expenditure on defense was about 4%. Post Soviet collapse, we've sort of gone to like a peace dividend of like roughly 2% of GDP. All indications, if you look at announcements by most countries, is that we seem to be starting to climb back up the ladder of military expenditure. So just trying to get a sense of like how you think about geopolitical risk as a larger subset, maybe driving kind of gold acquisition.
Yeah, so I think this is kind of more in regards to the first part of the paper.
Yeah.
So when I look at the military imports, I compute the share. So I don't actually use the dollar amount. And actually, I don't even really have dollar figures from them because I'm getting the data from SIPRI, the Stockholm International Research Institute, and they don't really. I mean, they have some data on the dollar value of the arms trade, but it's not really great. So I compute the share based on their metric that they call TIV, a trend indicator value, which is the way they sort of measure like how, like what's the actual military significance of the equipment that's being traded, and it's almost certainly going to be pretty well correlated with the price, but it isn't precisely a measure of the price. But anyway, but I do. The analysis shouldn't be affected by like whether the level of imports is moving up or down, because I basically take the ratio of it's basically USA minus China minus Russia over the sum of those three, so USA plus China plus Russia. So if the level's shifting, that shouldn't affect the share. Now, the one other thing I will also mention is about maybe this is a little tangential to your question, but also the question of like the location of the gold, I think, is an important one. It's something I don't know. Obviously, if countries are buying a bunch of gold and storing it in the New York Fed, they can't be doing it because they're concerned about U.S. sanctions. If they are, they clearly haven't thought that through. But there's just no way to get that kind of data from the New York Fed. I mean, they wouldn't share that kind of information. And I think they've actually even like revised their website a little bit to remove some of the information out there about their international account holders. So yeah, it'd be certainly an interesting data set to look at in terms of disentangling like who's buying gold because they might be worried about sanctions versus who's buying gold just because they like the investment characteristics of it. But I don't have a way of doing that without having access to that kind of data.
Yeah, and that brings up a point that I think is relevant also to Bitcoin, which is like the means and like the mechanisms by which central banks would acquire gold and or nations would acquire gold, whether using the central bank overtly as the custodian and publishing as part of their, say quarterly updates to their portfolios, or whether they would use some, state affiliate institution like a sovereign wealth fund or a state bank to do those acquisitions in a way that doesn't, show as much of a footprint on the national balance sheet. And obviously that's relevant to Bitcoin, right? And especially if you're worried about sanctions, right, you would do this in as a covert manner as possible. So how does that affect how you think about kind of doing this modeling with the published gold shares of the central banks when we could presume there's probably some proportion of those national holdings that are not on the books?
Yeah, so there is a little bit of evidence from previous literature that central banks tend to underreport their gold holdings not because of actually sanctions, but because they don't like the volatility that's associated with it. So they don't like having to report that the U.S. dollar value of the reserves is declining as a result of just changes in the market price of gold. So yeah, I mean, I don't have a way of correcting for that. Although that's sort of an interesting question. Try to think about like estimating, how much gold are central banks holding off the books. Certainly, though, if that's the incentive is there for gold, it would be even stronger for Bitcoin just because the U.S. dollar price is much more volatile. So, yeah, and again, also for the reason you mentioned that if you're buying Bitcoin, you're thinking of it kind of as an insurance policy, which really actually is kind of the point of this paper. Where like there's a lot of people who argue like, is Bitcoin money? Is it a currency? And so forth. I mean, I don't necessarily know if it's money or a currency yet, but I do think it is a store of value, and I think it is kind of an insurance policy. And if that's why you're buying it, because you like this kind of sanctions resistance, which I won't say sanctions proof. I mean, there is evidence that when the U.S. Treasury sanctions certain types of crypto wallets, that activity kind of declines in some of them, depending on the what they're being sanctioned for and what type of actor it is and so forth. But there is this resistance where if you've got Bitcoin in a wallet, there's no way the Treasury can block you from sending it to another person or another entity. So that's what makes it interesting.
Yeah, certainly. So another question. This is kind of more on the, I guess again, you can't put everything in some of these models, right? You have to make certain assumptions about, particularly like the purpose of these portfolio of this portfolio of reserves. So when modern central banks hold treasury securities or dollar balances, they usually don't just hold them. They often like re-lend them out into the swaps markets, and they basically are major sources of dollar funding in the sort of Eurodollar system. In fact, that was like a potential issue that was worried about when we sanctioned Russia's dollar reserves, is those actually had been essentially part of the offshore dollar lending market. And when those were just essentially blocked off, there was worried about potential contagion risk. I think there was maybe some things done with swap lines to mitigate that in the acute sort of days. But that is like a sort of a function of how central banks use their reserves. It's not just sort of static sort of dollars in the bank account. They usually are trying to maximize their return, so they're relending them. They're engaging essentially in quasi proprietary like trading operations. So obviously gold is harder to do that. Gold is more like, people, they do lend their gold also in gold markets. And there's like a paper market for gold as well that is traded often more than the physical bullion. So if we're extending this to like, okay, how we would model like their use of Bitcoin, right? Like, do you think they would rehypothecate their Bitcoin? Do you think they would treat Bitcoin truly as just like this outside insurance policy, or would they think about it as like, okay, I now have this sort of speculative reserve asset, diversification. I'm going to lend it to Genesis to have them do some proprietary sort of rehypothecation. I tend to doubt that he would, but that means that they can't get that benefit out of the Bitcoin than they can get out of that with a treasury security.
Yeah, I think maybe they could do a little bit of that, but they'd want to be really careful about who their counterparties are. So like, because if you're worried about, if the reason you're buying Bitcoin is you think about it as sort of an insurance policy against sanctions, then you're not going to want to buy Bitcoin and lend it to some entity that's outside of your sovereign borders, because then, if sanctions are applied to you and that entity is then unable to return your Bitcoin to you, well, now you've lost your Bitcoin. So maybe they would consider, for example, lending it to domestic crypto firms or domestic crypto exchanges, businesses that are kind of very local to the national economy. But in terms of kind of moving it digitally outside of their borders, I think that they would probably want to be very hesitant to do that.
So one thing you mentioned at the tail end of the paper that sort of I wanted to sort of pull the thread on is the renminbi and their push to first, right, set up an infrastructure for digital payments that is independent of sort of the Western financial infrastructure. So they're trying to set up cross-border clearing systems like the CIPS system. They're trying to set up their own digital currency electronic payment system, DCEP, and they're really targeting the sort of Belt and Road Initiative, sort of Eurasian periphery, but even across Africa into South America, kind of emerging market nations to sort of adopt their kind of preferred technical finance stack that also comes with kind of their surveillance and authoritarian governance stack alongside it. And there's obviously a lot of discussion kind of in the ether about, obviously the global sort of geopolitical confrontation that sort of seems to be getting more intense between U.S. and China across a whole range of sort of geoeconomic domains. But in particular, in the monetary domain, there's speculation that, sort of pricing of commodities becoming marginally denominated in yuan. There's major structural reasons why the Chinese capital count can't absorb those excessive sort of OPEC plus surpluses to sort of truly internationalize and sterilize those reserves with sort of bond issuance. But they seem to have a strategy of spreading this kind of digital payment clearing system to sort of it seems to sort of block the ability of the U.S. principally to constrain their ability to conduct trade if they were to get on the wrong side of U.S. administration or take some action, say in Taiwan, that might get them sanctioned. So they're trying to sanctions proof their own trading system, at least as a first order. That's my assessment, as opposed to truly trying to like internationalize the renminbi as a vehicle currency and try to create the CGB market as like an alternative to the Treasury market in terms of a global reserve asset. But just to like park that aside, that sort of second sort of speculative piece, just this idea of there being an alternative payment system that, a certain subset of the world, especially the world that is maybe the most vulnerable in this model to sanctions risk, has now potentially an emerging alternative in the renminbi clearing system, and maybe using a renminbi as a vehicle currency, if not like as a reserve asset. So that adds like a whole bunch of different complications to your model, but just kind of jumping off of your model, right? Like you didn't have renminbi as part of that portfolio sort of modeling. But if you sort of started like be more and more speculative, sort of going beyond the math per se, how do you think that might change the calculations of some of those? Like for example, I'm thinking like OPEC, GCC, India, these sort of middle balancing powers that may not be a target of primary sanctions, but you also mentioned here maybe the target of secondary sanctions.
Right.
And they rely a lot on exports and trade with China, who's maybe their number one trading partner, and they really don't want to have to be vulnerable to just a swift cutoff or punishing secondary sanctions with their main trading partner. And so this adds, I think, a new geoeconomic wrinkle to the analysis here. In the sense, that is a separate clearing system from Bitcoin, where Bitcoin is not just this reserve asset, but is itself a settlement system that is outside of the existing settlement system. So those are two different functions. Like one is sanctions protection for the reserve asset itself, like this thing can't be seized from you, but also it's a censorship resistant settlement system, right? At least if you're dealing with a counterparty that is willing to reject the impositions of OFAC. So yeah, I just threw a lot at you to kind of consider, but kind of jumping off of the renminbi and sort of DCEP, and maybe there's two different aspects of kind of sanctions resistance.
Yeah. So let me actually start with your point about Bitcoin, where you say it's both an asset and a kind of a settlement or clearing system, and it is. I mean, and that's kind of one of the things that actually is unique about Bitcoin compared to, let's say, gold. I mean, gold is an asset, but it doesn't come with a built-in settlement or clearing system. So, and in fact, it's actually very costly to conduct transactions in physical gold, because you got to like verify that it's real. You got to secure it and transport it. There's like all kinds of logistics and stuff with that. So that is a nice thing about Bitcoin, that you can, if somebody sends you Bitcoin, like the whole sort of mining blockchain process verifies that it's legitimate, and you don't need to hire an outside expert to look at your wallet and determine whether the Bitcoin that somebody sent you is counterfeit or not. And so that actually is a potential benefit of having some Bitcoin reserves, that you're able to participate in a sort of a payment settlement and clearing system. Now, that is outside of let's say SWIFT, the U.S. dollars, that kind of stuff. Now, whether you want a kind of a third one on top of that, which is what China may be trying to set up, I mean, just from kind of a diversification standpoint, I'd say probably, it makes sense for a lot of those countries to pursue having kind of some at least a backup option, right? I mean, even if they want to, for the time being, just keep doing business in dollars. I mean, in the event that just something goes catastrophically wrong with their relationship with the United States, or a Taiwan scenario where there's just huge amounts of sanctions and secondary sanctions that both China and the U.S. are applying to each other. For countries to have kind of all their eggs in the U.S. dollar basket, both the asset basket and the sort of payment settlement clearing system basket, it seems like it's probably worth it for them to diversify a bit. So yeah, I mean, I think that is a good argument for China to make. I want to go around to kind of promote, why countries ought to think about kind of alternatives to the U.S. dollar. The one thing I will say though about Bitcoin and its potential use is a kind of a settlement or clearing mechanism for international trade. I've struggled to find any kind of large scale example of this. I mean, it's certainly like you can find dark web markets, right, where people are buying, mostly drugs, and they're being traded around the world, and so. But I think a lot of that actually is not even using Bitcoin anymore, because they're using other currencies that are more privacy focused. They don't want sort of a public record on the blockchain, and they're also conducting transactions that are much smaller than what you'd need for the scale of international trade, where the depth and the liquidity of Bitcoin would be more important. But still, the problem with Bitcoin really is its volatility. So if you've got something that's moving 5 or 10% a day against other currencies, I mean that's just like an order of magnitude more risky than any other currency pair you can possibly think of. I mean, except maybe some currencies are experiencing hyperinflation or something, but that's a real problem for conducting international trade, because you just can't enter into an agreement where you don't know how much the thing you're receiving in payment is going to be worth. You just don't have any way of coming up with a reasonable estimate that's and it might make a big difference too, because depending on how the currency swings, you might end up having to eat a big loss on that trade, or you might end up with a big profit. But that's a risk that firms are going to be very hesitant to take on. So that is potentially an issue. And so, but maybe there is a way to kind of sidestep a little bit of that by sending the transaction over the Bitcoin network, but then immediately converting it into some other currency or something. So there may be other ways to kind of basically borrow the settlement and clearing infrastructure of Bitcoin without borrowing the asset characteristics of it, which is where the volatility comes from. But yeah.
Yeah, no, that makes, I would agree with that. So there's a few different angles I could take on this. So one is, and I think this is interesting, again, more speculative, right? I think all this is more speculative. So I guess, just put my cards on the table, right? I think in terms of, evolutions of the monetary system as being somewhat downstream of evolutions of the geopolitical sort of balance of power arrangement, right? When there's a global hegemon who can sort of set the rules and enforce the rules of the global balance of power and the international system, its currency tends to be the one that's the dominant sort of trade and vehicle currency. It tends to be the one that is, dominating most financial transactions. As also its bond market tends to be, or at least its reserve asset holdings tend to be the ones that are most trusted, by other actors in the system. So I sort of have to imagine if you're presuming some sort of major shakeup to the global monetary system, you kind of have to sort of think about, well, what associated shakeup is occurring in the geopolitical system. But there you're looking through a mirror darkly, right? There's lots of ways those sorts of shakeups historically have gone very, very badly. So this is trying to apply this linear modeling to what is likely going to be very nonlinear, kind of disjunctive, kind of historical process, and exactly know what's on the outside of it. But sort of reason why I framed it that way is that, to your point, as a set of hedging actions, one thing I'm interested in thinking through is what is the second order effect of these hedging actions in aggregate, right? So this model presumes kind of an individual portfolio allocation given this sort of risk assumption. But once this gets started, right, there's a sort of a reflexivity to people hedging against other people's future hedging, and that as we can see, can tend to lead to sort of nonlinear outcomes, right? And so I wasn't sure how you think through that process, right? Obviously, these are semi-rational actors, right? They're trying to not just be the first person to adopt Bitcoin for the sake of it, but if those are strong signals that geopolitical actors are sending to other actors, those signals get picked up on and get acted upon by those other actors, and that might include changing their portfolio allocations in ways that drive the distribution further away from maybe what it is in this existing model.
Yeah, and so that may also be the reason why countries may not want to disclose that they're doing this, because they don't want to kind of signal they don't want criticism of what they're doing, and they also don't want to move the price of Bitcoin in a way that's not push the price up before they're able to acquire however much of it that they decide that they want. In terms of thinking about the central bank's reserve allocation as a signal, I think that is an interesting way of thinking about it. certainly, like if you go back to Russia, for example, maybe we should have thought a little bit more carefully about why they were so keen on removing dollars from their portfolio and replacing it with gold and renminbi, and sort of what did that tell us in terms of their future intentions, say for Ukraine. Of course, hindsight is always 2020, and there are other countries that have been also buying a lot of gold, like Turkey is one of them. I guess Turkey does have some military assets in Syria, so I don't know. Are they going to take over the rest of Syria? I don't know.
Well, I mean, but they just basically are the ones convening peace talks and trying to squeeze the U.S. out. So. I mean, that's a separate sidebar in terms of Erdogan's aspirations and Turkey as a kind of a bridging power between Asia and Europe, and their sort of neo-Ottoman aspirations. But that's a sidebar.
but it's interesting that comes along with like a big gold allocation, right? It's like what is kind of what's the thought process there? It's interesting. Not of course, not to say that the monetary policy of Turkey has been a great success. So, but I don't know where were we?
Yeah. So, well, I think basically, they would keep it a secret, right? They wouldn't want to just trigger this unless. So, the only reason I kind of set that up is not every actor is the same in the global system, right? Like there are clear power centers, and there's clear differences in how they sort of play a role in the global economic order, right? In terms of whether they're net commodity producers, whether they're net sort of goods surplus countries, or whether they're net sort of deficit consumer nations, right? And those also map onto the geopolitical alignments, right? Like OPEC plus, the sort of marginal pricer of the barrel of oil and gas to a certain extent is sort of autocratically aligned, right? A lot of these, systems of government are not exactly liberal. The sort of marginal producer of manufactured goods consumed by the West, China, right, also has very ambitious geopolitical aspirations. And the sort of G7 sort of dominant kind of legal, military, sort of technical set of powers, more liberal, oceanic, kind of maritime oriented powers, they're the net deficit countries. They're the net consumers. And the global system sort of worked when those those sort of three legs of the stool were kind of in frenemy mode, when we all kind of agreed to sort of cooperate in a global system, recycle surpluses, run these deficits to absorb those things, bail out the global shadow banking system to make sure no one else had their economies collapse, have somewhat of a coordinated monetary policy and handoffs between central banks. So the system was working, right? At least for certain subsets of the global population. I don't know, I guess my read is that all those legs of the stool are coming under stress, right? Like the leg between Russia, Russia's exports and the G7 coming under sanctions, the leg between China and the US coming under increasing export controls, sort of technology restrictions, going to be increasing sort of capital restrictions, investment restrictions, all sorts of increasing economic war essentially being applied between these main elements of the power of the existing power structure. So that's how I sort of think about the global dynamic, not just in terms of portfolio allocation of central banks, but how are they trying to match their portfolio to their role in that system, right? I think you have some mention of that in the paper. One version of the model is you want to match basically your currency composition for your exports versus your imports. But that's I guess jumping off of that more broadly, thinking through. It's going to be a handful of these critical actors in the system that could decide to make a more overt disclosure, not just of maybe hey, we're going to actively try to do something with gold and try to remonetize gold or do something related to what's always been kind of to me it's a little premature, but it sort of is in the zeitgeist. It's this BRICS Eurasian commodity gold something system, right? Everyone has a different version of what they think is sort of in the ether. But the reason why it's in the ether, right? It's a clear sort of set of institutional incentives that those powers have to sort of try to get out of the yoke of the dollar trade system, even if they're basically fully integrated into it. So this is a wind up to say, I think back to 2008 when the financial crisis occurred. Secretary Paulson came out in his memoirs and said that, he was aware at the time, I don't know if it was intelligence collection or what, that the Russians tried to approach the Chinese and started to do a coordinated fire sale of their treasuries and agency mortgage-backed securities, just try to like punch us while we're down, basically try to like throw fuel on the fire and destabilize our economic system and political system even further. And recently I heard an interview with Paul Tucker, who was the former number 2 at the Bank of England. He wrote a book called Global Discord, and he's been hitting this point pretty fiercely the past few weeks, is saying like with the West and the U.S. in particular cannot afford another great financial crisis. Like this instability of the shadow banking system is an acute national security threat because of these very kind of the geopolitical frictions that underlie the existing monetary system. So I'm like motivating this idea that certain powers may have an incentive to quietly accumulate either Bitcoin or gold, right? Obviously, it's probably much more gold relative to Bitcoin. But then they're sort of preparing for a moment, right, where they think they can disclose it, and it would not just be like, hey, like we did this for our own self-protection. They would probably do it. They probably want to weaponize the announcement in some way, right? They would wait for an opportune moment of a Western geopolitical confrontation with China, some monetary instability, some blow up in the repo market. And then they would want to, add fuel to the fire by adding uncertainties to the stability of the global dollar system. So those are just like some of my speculations, right, in terms of like the motivation for acquiring these non-dollar or non-sort of G7 fiat reserve assets. First, as a hedge for probably the majority of the actors in the system, but as also as like a preparatory action, right, for like maybe a larger coordinated effort or at least response to a larger geopolitical confrontation. Obviously, Russia seems to have built that into part of their strategic calculations as they, had these designs in Ukraine. Like my attention goes to China and thinking through like what are they, building as a hedge, right, to first block U.S. power, but then what are they actually looking to build as a way to sort of reset the balance of power and rewrite the security and economic arrangement on their terms, at least in the Western Pacific. So those are a lot of my more speculative ramblings there. But like this is where the connection between these monetary dynamics and central bank reserve allocations and these kind of larger geopolitical drivers like are sort of wanting me to look.
Yeah.
So any thoughts on that? That wasn't really a question. That was just me sort of throwing a bunch of stuff out there for you to get your reaction.
Yeah. So one of the kind of a related, closely related to this is this notion that like people use dollars around the world or hold them as reserves because the U.S. sort of backs it with its military. Like there's some connection between the strength of the U.S. military and I don't know. So this connection between the strength of the U.S. military and like the extent to which dollars are used in the international financial system. I've never found that argument to be very compelling or persuasive. I mean, it's not like the U.S. military is running on the world and forcing people to use dollars at gunpoint. So I think it's more kind of just a confounder is the size of the economy. I mean, the U.S. has a very large economy, and its tax base also. It's like a large percentage of it is capable of being taxed. So the fiscal capacity of the government is high. So the U.S. government can afford to spend a lot of money on the military, which it does. But also because it's a big economy that there's a lot of just dollar transactions inherent in that, and then people around the world don't want to deal with as well. U.S. firms are going to have accustomed to dealing in dollars, so they say, okay, we'll deal in dollars. And then there's just this network effect, which I think you're also kind of talking about, where one person starts using dollars and other people start using them, and pretty soon there's like lots of people using dollars, and indeed like the portion of dollar denominated international financial transactions is much larger than the U.S. Economy's share of the world economy. So definitely kind of suggests that there's this kind of feedback system type effect where some people start using dollars, more people start using them, and having a lot of people, I should say everybody, but a lot of people using the same currency is probably a good thing in terms of reducing transaction costs, because you don't have to really think about like if I'm dealing in 5 different currencies, and do I need to like set up a like an FX shop or something where I'm hedging the movements of these currencies against each other. And certainly big firms would have the bandwidth to do that, but smaller firms, maybe not. So Yeah. So kind of thinking about then, like, what does it look like if we move to a system where dollars are a much smaller share of, of international, financial transactions? Yeah, I mean, it's probably going to be, kind of a component I mean, it's sort of the financial component of friendshoring, right? The idea that you want to, or you might want to think about, like, where your manufacturing is actually being done, and sort of what are the geopolitical implications of locating a lot of manufacturing facilities in countries that are not necessarily all that friendly, or at least have, let's say, political disagreements where those kind of can spill over into the business realm. And so this is kind of the we're sort of talking more about the financial side of that, which is what are the implications of conducting transactions, kind of in one currency versus having maybe multiple.
Yeah, and the way I sort of think about it, again, is more like crude engineering physics analogies, is the dollar as a unit of account seems to have a relatively strong, stable equilibrium, in the sense that it's a social network that everyone wants to be a part of, right? And so there's cost to leaving it, and the more people that join it, the stronger the costs are to leave, because there's less people now that will trade with you. But I sort of try to analytically separate out those sort of network dynamics for the dollar, right? Like why we denominate so much international trade, the foreign exchange, swaps markets, interest rate forwards, we're all in dollars, right? There's this sort of feedback loop between that and just the size of our economy, the size of our financial markets, et cetera. That I don't think it's like a direct causal link between that and the fact that we have a bunch of military bases around the world, but it's the fact that, like, we dominated after World War II. We were like the center of global industrial production, this the largest source of consumer demand. So, like, everyone started trading in dollars. Soviet bloc was kind of locked out. They had to acquire dollars to sort of engage with the Western system, which was, like, economically much larger. And then their dollar accumulations generated the Eurodollar system, and that just became like a great source of sort of offshore dollar funding for banks that were sort of free to, like, go around and, like, make a buck. And then of course there's this sort of the Jeddah deal, and that's a whole different story. But what I think about the status of the dollar, right, as a unit of account being very stable, versus the status of the U.S. Treasury security as a reserve asset being much less stable in terms of the reinforcing dynamics that drive people to the dollar, right? Usually they sell treasuries to get dollars. And we've seen sort of blow-ups of the market where like, for example, March of 2020, when there was an acute, panic and people wanted to just dash for cash, there was, basically a breakdown in the off-the-run treasury market, where sort of dealers' capacity to absorb, selling just froze up. They said, we're not going to do this anymore. The high frequency traders that basically dominate 60-70% of the liquidity in the treasury market just stopped trading, and the market just froze. And the Fed had to come out and say, okay, like, this is like stage 5, like, panic. We need to, like, open up all these facilities. We need to do QE $1 trillion in 3 weeks, and basically try to become the market maker of last resort for repo market, and to make sure the treasury security, which in my sort of mind is like the foundation upon which, like, U.S. economic hegemony ultimately rests, right? It's what has allowed us to accrue this kind of seniorage benefit, to run these structural deficits. We've been able to, like, create a safe asset that the world kind of structurally needs, and surplus nations that we can sort of bring into our security arrangement, sort of recycle those surpluses into our debt and asset markets, and so we get to sort of basically finance our deficits and grow our military and our social programs, essentially with an external subsidy. That has had sort of pathological effects that have been noted by other people, right? That it has benefited certain sectors of the economy, like the fire sector, that is basically grown up to absorb and direct those external surpluses into financial assets. But it has had a cost of essentially eroding our industrial capacity that the military is now waking up to. The fact that, like, we can't make aircraft carriers as fast as or submarines as fast as China. Our ammunition supplies are dwindling, and our ability to make more of them, given the rate of consumption in Ukraine. Like, these things are, like, starting to, like, become recognized, at least that I see in the national security apparatus. Like, the benefits that we accrued for 50 years by sort of running the system and be able to basically print a safe asset for the world, has sort of started to create sort of erode some of the aspects of national power. And that's why I sort of think through as like a risk that's like a tail risk that's like growing, right? So if you're thinking in terms of like the next 5, 10, 15 years, is if the Treasury security is the foundational reserve asset for the world, and if that reserve asset is reserve asset because it's safe and liquid, right? And safety meaning that it won't like vastly fall in value very, overnight, right? Like Bitcoin could go up or down. And it's, safe from seizure, right? You're not going to like wake up one day and not be able to, spend it or sell it, right? And it's liquid because it's such a large market that you can, sell it and buy it without, much of a spread. Like those are like the foundations of how much like why the Treasury security is the global reserve asset. And it seems like we've had issues in the past 2 years of just like of taking hits to each of those like key dimensions, right? Like its liquidity has started to show some strain during these periods of like dollar strength, and Secretary Yellen came out and said we were worried about signs of illiquidity in the Treasury market, and then there was a flip with the Bank of Japan, and then the Treasury got a bid all of a sudden, so yeah, that's where I think like there's some like concerning signs on the horizon, at least that I see. Is obviously if we go into recession, there's going to be a flight to safety for treasuries. But I think if there's a 5-10 year horizons, like we're going to be printing $2-3 trillion of deficits in a recession per year. Balance sheets capacity for absorbing treasury issuance, like where is that going to come from? Especially if geopolitically people are trying to hedge against it. So I just see like that's more of an unstable system, right? Because people only hold the treasury security because it's safe and liquid. And if it starts becoming less safe and less liquid, the reason to hold it sort of starts to go away. Whereas you would still denominate your trade in dollars because everyone else is going to keep doing that. But that's like your daily liquidity or like your trade liquidity needs to be held in dollar deposits to have some treasury reserves. But like your national savings, like the subject of your paper, like sovereign wealth, central bank reserves, like that's a much more longer term decision. And then if they start to feel like political risk and geopolitical risk are rising, like they might have to hedge. And that for me, like I worry about that as like a national security risk that's coming in from the tails. And we're sort of putting more stress on the treasury market, and I'm not sure that it can carry the weight of the geopolitical tensions that we may face in the next 10 years.
Yeah, I mean, so I think in terms of like what does it take for the treasury market to clear, right? I mean, the question would be also like what's the interest rate? So if a lot of countries around the world decide, or even really just one big country like China decides that they want to kind of just get rid of these treasury securities, well, they're not going to go away. I mean, they're just going to trade them to somebody else, and most likely that's going to be an investor either maybe in a very friendly European country or in the United States. So there's going to be this kind of reshoring of or there could be this kind of reshoring of like the ownership of financial assets where kind of U.S. treasuries increasingly end up being owned by either U.S. entities or at least entities that are very, very friendly to the U.S. And likewise, the rest of the world thinks more carefully about gold, maybe some Bitcoin, maybe renminbi, maybe a very diversified basket of other things. But if you want to motivate U.S. investors and maybe some European investors to take on all these extra treasuries, then that's going to the interest rate will need to go up to incentivize that. So now that's kind of the mechanism through which then the debt becomes less sustainable. The U.S. national debt becomes less sustainable. The fiscal capacity of the U.S. sort of declines. And we have this kind of higher interest rate environment, which also is obviously bad for investment, right? So
well, and it makes for me like there's a growing contradiction between like two critical elements of national security, like economic policy. One is the stability of the treasury market, and two is like decoupling from China, right? Like it seems like we can't really have both. Yeah. Because the stability of the treasury market was contingent on having this sort of global dollar recycling system where like we run massive deficits and we absorb the like those surpluses into our assets. But if they're not going to be the net, if the foreign net buyer isn't going to show up and it's going to be a domestic buyer for those assets, well, that sort of global balance of payments doesn't quite work.
Right.
And like you need to shift to like a very different like global trade and economic arrangement to like I think drive the sort of reshoring that's sort of talked about, but it doesn't seem to be manifesting, right? Like our deficits with China are like all-time records. So like you would need to see like dramatic change in the basic pattern of capital flows that would have a lot of like second order consequences for the stability of the treasury market. Like I see no way out other than like essentially financial repression, right? Where the Fed and domestic institutions are essentially forced buyers. And there's like an implicit, if you can stretch that out, right? We did this sort of after World War II, right? Where we had to run massive deficits, 120% GDP. And we just said, all right, we're just going to like kind of burn it off over the next 10 years through like high inflation and keeping yield curve control. And we're just going to like, kind of like, but we were a stable society, right? Everyone was kind of like Ray Raw America. We were the most, dominant power. So we could kind of like, I think, take that pain a bit in terms of doing that internal transfer, basically. Now, like that's where I was like, it seems like we're trying to play that game, right? Run a spike of inflation until we just hit like the panic point, and then come back and like crush it, right? And then we're gonna do that again, and then I think we're gonna like do this roller coaster a bit this decade. I just feel like it's much riskier. It's a very different geopolitical environment. It's very different domestic political environment. But all these things I think about, I wonder if like the sovereign wealth manager of this of Sama, right? The Saudi sort of central bank asset manager, or the PIF, or even the Singapore National Wealth Fund. Like what are you're trying to like model their decision making, right? And I think you said in Pom's podcast that oftentimes sanctions are like a pretty much an executive unitary power, and you might think the U.S. political system may be friendly to you in certain respects. I mean, you have a really good lobbying operation if you're, Dubai or the Qataris. But like the president can just sign an executive order like in a day that sort of, hits you. And, so you have to put a lot of trust in not just like U.S. geoeconomic power and like the military, but you have to trust the specific institution of the presidency and whoever Americans might elect into that over the next 10, 20 years. And that seems like the risks start piling up, right? In terms of how I think about Bitcoin as an insurance policy or gold as an insurance policy, that like they start pricing in additional political risk premiums, geopolitical risk premiums, beggar thy neighbor kind of risk. Like all these premiums start to add up, right? And I just worry that that's like that we're not sure like how much we're baking that into our national security strategies.
Yeah, no, that's right. I do, however, wonder whether, it's interesting to think about, like whether that geopolitical risk is actually priced in financial assets. I mean, I don't have a clever like identification strategy for that off the top of my head, but I mean, it is interesting because the thing is that the risk varies a lot based on who's owning them. So. Like you wouldn't necessarily think that an asset would trade like you only get a risk premium for risks that are not diversifiable, right? But the geopolitical risk might be diversifiable just by virtue of shifting the asset from an entity that bears the risk to an entity that doesn't bear the risk, and that so basically like the system just the financial system will just facilitate a kind of risk sharing equilibrium where countries that face this risk just don't have assets that are exposed to it, and so then like there's not necessarily a risk premium per se associated with that, but I mean it's I do think I think you're right that like in a scenario where China, let's say, wants to get rid of a lot of its reserves in treasuries, that will also probably have some effect in terms of like a rebalancing of the deficit, the trade deficit, the U.S. trade deficit with China. That like it just if they're determined to stop dealing in U.S. dollars, that means that probably U.S. isn't going to be buying as much stuff from them, and so for us, actually for the U.S. that will be very inflationary. I mean, a scenario where all of a sudden we have to relocate a lot of manufacturing, either bring it back onshore or move it to other countries with higher labor expenses. And then you also have to have a lot of investment to build up infrastructure to manufacture stuff. That's a scenario where also it's kind of very stagflationary potentially, because you're looking at a scenario with higher interest rates and a lot of inflation. So
yeah, because I think about like even scenarios like short of like actual like war, right, which are bad no matter how you slice it, right? If it's like there's two models in my mind. Like one is like the pre-World War I model, where you have the status quo mercantilist power, Britain, whose currency was reserve currency. I mean, it was bullion backed, but the pound was basically the dominant trade and finance currency. And Germany, the sort of rising continental power with a lot of aspirations geopolitically, wanted to set terms on their own. And those economies were extremely interlinked. Like, in fact, they were growing up until basically, the moment. I think there was a report written by like the Royal Society in like July of 1914 that was essentially an assessment of like the growing trade interdependencies between Germany and Great Britain. And there was debates, right? Like it would be insane for there to be a war because of the degree of economic destruction. These systems are so dependent. So that's like one model. That's like the depressing model. The other model is just like kind of a long century of competition between U.S. and China, maybe like Britain and France in like the 19th century. And I think this is Paul Tucker, his sort of preferred model, I think his optimistic model, where there's no like acute disruption, but where there's just sort of this, intensifying competition, rivalry, enmity, and, kind of, balancing powers to try to play one off the other. But when I think about like the balance of capital flows, right? Like, we have a lot of objectives that we've sort of set for ourselves, even in scenarios short of war. But like we need to rearm both ourselves and our allies to like meet a higher, threat environment and to meet a peer challenge, what the Defense Department calls the pacing threat. So we need to invest more in our defense industrial base and next generation weapons and help support our allies in building up their military capabilities. So like those are defense outlays that have to increase. We have like retiring generation that's going to draw down on these entitlement programs. And I think Social Security is going to be like a net seller of treasuries to fund payouts now. Medical costs are only going up, so Medicare is going to get more expensive. We have these ambitious, climate net zero objectives, which imply we have to do this really expensive energy transition, rewiring our grid, massive capital investment, big sort of industrial policies, essentially, to both like move away from fossil fuels, incentivize renewables, but also reshore. So do like CHIPS Act sorts of industrial policy, like subsidies from the government to sort of, drive capital flows and subsidize them. And we have to essentially build up our inventories to prepare for like other shocks. Like I think a lot of countries are going to look around in the post-COVID and then the post-Ukraine environment and realize, global supply chains maybe aren't as like reliable as they thought. Countries have to feed their populations. Countries that have to, have a lot of their critical inputs, like need to be closer to hand, whether it's in inventories or, in nearby countries. And lots of redundancy needs to get built in. Those are all seen, like, to your point, like this is all very inflationary, but they're also like, in my view, like not quite those are not expenditures that are very interest rate sensitive because they're almost like geostrategically necessary. And so the government will have to provide some subsidy to those things. But the government is going to have to be financing those outlays at an interest rate that like doesn't cause them to default. and that's why I see no way around this other than they have to cap rates at some point this decade. But that's where you get to the point where like you essentially have to euthanize and essentially nationalize the Treasury market. But then you're really rug pulling the rest of the world from the last 50 plus years of the global financial system, where that treasury asset was the foundation of the global reserve asset. But if other countries are seeing that coming and they know there's going to be a rug pull on the treasury market sometime in the next 10, 15 years, like they don't want to be the ones getting rug pulled. So that's why I worry about there's like this, it's where gold, like for me, my worst case scenario is there is some acute geopolitical confrontation. Maybe the US, for whatever reason, politically, militarily, whatever, can't reinforce its hegemony and essentially, takes a hit to its global standing. Like that would be bad for democracies worldwide. And it would mean that probably a lot of countries, like, I don't know if there's like a reemergence of some type of gold standard. And in that sort of scenario, like the Eurasian autocrats sort of win, right? Like the countries that have the most gold, that have been acquiring the gold is, as we talked about, China, Russia, Turkey, India. And so like if that's the system that kind of gets marginally advantaged, that's like bad for the U.S. And so like this is where I think like Bitcoin is a like a speculative long-term hedge for instability. Like plan A is keep the Treasury market stable. Plan A is reinforce American global hegemony. But sometimes history tells us plan A doesn't always work out. And if like the default like alternative for powers that have to rebalance to a new geopolitical arrangement is gold, that's not a great system for us, at least marginally, especially a gold clearing system that maybe is going through Chinese and Russian like financial infrastructure. So I don't know, like it's where like I think Bitcoin is like an interesting thing to like keep on the back burner, like because it's a reserve asset in a clearing system that isn't a Chinese clearing system or digital yuan, and it isn't a Chinese bond. It's a neutral reserve asset, so it's not like necessarily like pro-American either, but it's like not necessarily pro-Eurasian. So it's like it's a third alternative that like maybe you want to keep in the toolkit as a backup plan, even for the dominant power. Obviously, the dominant power is never going to be interested in an alternative until it becomes necessary. But yeah, that's like my like longer term or speculative thesis. But yeah, reactions to that. We're sort of going off into these longer term tangents, but I think they're interesting.
Yeah, I don't know about the return of like specifically a gold-backed. I mean, the problem with a gold-backed, whether it's commodities or gold or Bitcoin or whatever, but the problem with like specifically, backing a currency with it is that then it makes like global kind of structural deficits unsustainable, right? Because the country then that's running the deficit is inevitably, if it runs that deficit forever, will run out of gold or Bitcoin or whatever it's backing the current, and then at that point it sort of has to kind of break the peg and that's exactly what happened with Bretton Woods, right? As the U.S. was running these deficits plus a lot of government spending for the Vietnam War, and its gold reserves were dwindling because it was countries were redeeming their U.S. dollars for gold, and so Nixon looked at that and basically said, well, if we keep this up, we're going to run out of gold. So it's not sustainable in the long run. So I don't know if they're going to want to do that, and I think they also probably appreciate the benefits of having kind of flexibility in terms of running their monetary policy. Where they don't have to think about, for example, maintaining infrastructure for redeeming currency for gold and so forth. But that doesn't necessarily mean that they won't have reserve portfolios that have a lot of gold in them, and that gold and other kinds of, kind of, again, like maybe a more diversified set of things, possibly including Bitcoin, it might end up kind of taking more the place of where dollars once used to stand. Yeah.
Awesome. So let's like kind of wrap up this conversation. I want to take it back to earth. We've sort of been floating into the speculative ether, which I think is fun. But these are the times we're living in. I'm curious to hear like the reaction that you've seen to the paper, I guess from your institutional colleagues and folks who I think like the latent prior for Bitcoin is like skepticism, if not like malign disposition. But I'm curious to hear like what your reaction. What sort of the median reaction has been?
Yeah, I mean, I think people think it's an interesting topic. I mean, the sanctions against Russia, I think, really made it more relevant. I mean, if it hadn't been for that, I actually probably wouldn't have even used it as my job market paper. I would have used something else because it would have been just too difficult to sell to try to convince people that this is something that they ought to be thinking about, considering that before the Russia sanctions, that the only central banks that ever really faced asset freezes were in a much smaller in terms of both their reserve assets as well as the size of their economies, like Iran and Iraq, North Korea, Venezuela, Syria, Libya,
Afghanistan.
Yep. Yeah. So I think that's actually pretty much a complete list. So it's, you're not talking about countries that are at nearly the economic size of Russia. But now, yeah, I mean, I think there's a recognition that that's something that's worth thinking about, having a model that at least gets you some answers to that, or some kind of disciplines your way of thinking about it, which is, all models are wrong, right? But some are useful. So you always have to ask yourself, how useful is this, and does it correspond to the reality of whatever the system is I'm trying to model. So yeah, I think also, but I think there's a lot of interest also in just like sensitivity analysis, right? Like thinking about, if I vary these assumptions, how much do the answers change? One of the more interesting questions I got also is, like, what about a situation where if you're under sanctions, you can still trade Bitcoin and gold, but you have to offer a discount to the market price in order to motivate people to trade with you. So that's something that actually Venezuela probably did, where the Wall Street Journal had an article about where they were chartering Russian aircraft to load them up with gold and then fly it into Africa where they were selling it. It seems reasonable that if they're trading gold in such a convoluted manner, that the people buying it were not paying a full market price for it. I mean, I don't know exactly what they were paying, but yeah, I mean, so it's like that's sort of thinking about the sense in which they may not be perfect sanctions hedges. They may just be kind of resistant in some way. And so, like yeah.
Well, and one of the things that I've been trying to think about, again, it's really hard to really pin down and answer this question, but like the global fungibility of Bitcoin in some of these scenarios could start to become challenged, right? Like gold is fungible up to a point, but to your point, like, people can track where the gold's coming from, and they know who's selling it to them, and they can demand a premium, right? And essentially that's breaking the fungibility of that gold. And I wonder, right, like Bitcoin is maybe more fungible in certain respects, in the sense that it's a digital asset, but it inherently like leaves a presence like in the open public blockchain. But I do wonder, right, if like there are different techniques, and it's a technology, right? So there's going to be, I think, an arms race ultimately between like increasing anonymity on sort of either Bitcoin itself, or more likely on sort of second layers that are going to try to maintain its fungibility over time. But if you're putting this scenario where it is in someone's portfolio, like they have to model that out, right? Like I'm holding this to be able to protect myself, but if it's got like a scarlet letter on it from OFAC, and only like 5 people around the world are going to trade with me, like even if I can technically trade with them, like it's going to be hard. Like it starts to degrade the fungibility, or at least the usefulness of it, right? It all comes down to like the censorship resistance of it. And for me, like these things are all intertwined with like a larger question, which is we don't have time to get into, is like Bitcoin mining, right? Of like what would be the second order impacts on the distribution of mining, for countries that if they take a material position in Bitcoin, do they take a sort of a proportional position in Bitcoin mining? That's El Salvador is kind of a test case for that. They've done some mining, but not a whole lot. They're starting to issue like volcano bonds. I'm not sure how much this is real versus sort of publicity. But yeah, I mean, there's been even some arguments like just separate from the national strategic perspective, like just on the climate side, right? Another fellow BPI, Troy Cross, and Andrew Bailey wrote a paper basically doing this analysis and showing that you can essentially do Bitcoin carbon offsets by essentially mining in a green way your share that you buy. So essentially you can essentially counterbalance your net incentives to the network to mine more by buying Bitcoin. You can sort of counterbalance that by just mining yourself. So like you can essentially make your net purchase neutral in terms of its effect on the proportion of Bitcoin mining going to different energy sources. So that would be like another incentive for like countries that like both from a strategic perspective, but also maybe from like an ESG perspective, want to like mine their own allocations. But that's going off into the spectrum of speculation. But I'm curious to hear like what do you think in a scenario where say this plays out, say in this range from 2 to 10%, right? It seems to be like the boundary of what seems plausible as like a risk-adjusted portfolio allocation to Bitcoin. Say that plays out this decade. Do you think there'd be an associated, rationale for those states to develop or to incubate domestic mining industries?
I mean, I think it certainly wouldn't hurt for them to find ways to develop the crypto industry, the domestic crypto industry. I mean, because if they've got cryptocurrency on the reserves, then I think we had already discussed about like they might be able to engage in lending with domestic institutions. I don't know about the mining so much. I mean, the vast majority of Bitcoin that exists or that will ever exist has already been mined.
Hmm.
So, I mean, even if you set up, just a huge Bitcoin mining operation, you're not going to really be able to mine a whole lot of Bitcoin at this point, and that's going to keep getting cut, in half every 4 years. So, the time to do a lot of Bitcoin mining was like 8 years ago or 10 years ago. Now, it's you want to acquire a decent amount of Bitcoin, you're not going to be able to do it from mining. You're going to need to buy it from other people or entities, and so yeah, I mean, I don't know to what extent uh, that's Bitcoin mining would be useful in terms of like the scale at which a central bank would need to operate.
Yeah, I mean, I'm thinking in terms of preserving censorship resistance, right? So right now,
Oh,
miners
oh, right,
go
right.
through go through pools, and the pools actually build the block. And
Yeah,
obviously, there's work on Stratum V2, which would sort of rejigger kind of block construction, and I think mitigate a good chunk of that kind of censorship risk. But right now, right, if you're a nation state acquiring Bitcoin and you're worried about your transactions being censored, like pools can be hit with OFAC sanctions and say like we don't want you to process nation state transaction. Marathon, famously came out and said, oh, we were not going to, process transactions to addresses on the SDN list, and then they backed away from that. But like technically and legally, that seems to be an avenue, at least right now, right? That may change with further developments. But that has to be a consideration for those states.
yeah. I think to some extent, although again, there's also the question. So this raises sort of an interesting tension between like what's the price of evading the censor. So
Mm-hmm.
because if central bank X is under sanctions and they want to transfer Bitcoin from wallet A to wallet B, and the issuer of those sanctions has basically told all the Bitcoin mining entities within its own borders anyway
Mm-hmm.
that they're not going to be allowed to process that type of transaction. So, by the way, that presumes that they know which wallets correspond to the central bank,
Yeah.
right? So that's again we get back to this question of do they want to close or not? Um, but but uh, the central bank could still offer to pay a very high transaction fee, and they may not even care all that much about that because they're probably going to be dealing in pretty large size transactions. So
Mm-hmm.
even as a percentage of the transaction, the fee is going to be small, but it could be large in absolute terms. And so that would theoretically motivate miners or maybe even new miners to set up operations and say, okay, look,
Mm-hmm.
we want to collect this premium from processing these transactions, and nobody else wants to touch them, but I don't care because I live in some other country, and I don't care about
Mm-hmm.
doing business with the United States, and who gives a who cares about OFAC, right?
Mm-hmm.
So there is kind of it's like it's a way in which Bitcoin kind of puts a price on censorship. Now, of course, if if a country actually kind of acquired 51% of mining computing power, then that would be very catastrophic for I mean, it would probably destroy confidence in Bitcoin. I mean, that would be very very negative for the future of Bitcoin. But I don't know. I mean, I think that we've also seen that Bitcoin mining is quite mobile across countries. Like when China banned it, it seemed like some of it moved to other places, and then now, although maybe not as much as we thought, because some of that may have been people just using VPNs to obscure where they're actually located, so they don't get caught. Um, but still, I mean, I think really, you just need computing equipment and electricity, so that can be moved around. Um, and yeah, I mean, I don't know. I mean, certainly, I think if you really want to kind of go jump into Bitcoin, like you think it's going to be really important as a sanctions hedge, as a reserve asset, it wouldn't hurt to promote some domestic Bitcoin mining, and just kind of the development of a domestic crypto industry. For nothing else, just kind of second order effects
Mm-hmm.
that if you're invested in something that promoting its usage is a good thing for you. but in terms of like whether you need to do that because you're worried about censorship, I don't know. I mean, I think this is kind of really something that's where Bitcoin has kind of crossed the threshold of where it's sort of censorable. Yeah.
Awesome. So I guess my final question is, so this is an academic paper, right? You're not making policy recommendations or anything like that, but you mentioned at the beginning, like what drew you to economics was really trying to think about the connection between, these analytical tools and the real world. So like, putting your policy hat on, and everything that, we've hedged in terms of the aperture of uncertainty. It seems like my biggest takeaway is that, one, like this is a plausible outcome. Maybe it's not like the baseline expectation that like by 2030, a large number of central banks will have some single digit percentage of Bitcoin. But I don't think like we can rule that out as a plausible scenario that like national economic and national security decision makers like have to put on the table for like serious analysis, right? If we're trying to come up with plans and strategies to sort of get through the next, 10 years, like this has to be one of those scenarios that we sort of build into those plans and strategies. At least that's my view. So like, one, do you agree with that view that this is like a scenario like needs to be seriously taken by kind of the existing kind of national security economic policymaking bureaucracies? And if so, like, where do you think they could start, right? Like not to like come up with answers to those questions, which are very hard as we've just sort of tried to wrestle with today, but like, where do you think is like, should kind of policymakers kind of take this as a serious topic?
Yeah, I mean, so I think that, well, I guess it depends on which country you're representing, right? So from the U.S. perspective, what you're going to want to do is try to convince countries that this risk of sanctions is not something they need to be worried about, right? Because if it's not something they need to be worried about, then Bitcoin, it just looks like this very volatile asset, doesn't give you much benefit, because if you're buying it to insure yourself against sanctions, but the risk is zero, then like what you're insuring yourself against something that isn't going to happen. So you're kind of just, there's no point in doing it. So, kind of reassuring countries that it's not going to do. Now, of course, that may also be just interpreted as cheap talk, right? Because obviously the U.S. is self-interested in promoting the international usage of the dollar, both as a payment network, because that makes our sanctions really strong, and then also as a reserve asset, which lets us borrow very cheaply from other countries. So. Yeah, I mean, that may just be interpreted as cheap talk, but maybe there is a way to actually make it kind of not so cheap, which is like Congress could limit the president's ability to issue sanctions. Like that's not a. Now, I mean, there may actually be interesting constitutional law issues with that. Like, I don't know whether that would infringe on, like, do you interpret sanctions as a commander-in-chief power? Like, right? Like, like I don't know. So I'm not a constitutional lawyer, but those are kind of interesting legal questions. I do think, as far as I know, that OFAC sanctions have never been successfully challenged in any U.S. court. So I think there was like a Russian oligarch who tried once and lost. So certainly, like the way it's currently structured, the courts don't have any problem with. So yeah, I mean, and then that gets back to where this risk comes from, that it's just the U.S. president doing it, and that's so maybe kind of trying to put some boundaries on that. Might be not a bad thing to think about from the U.S. perspective, or even also maybe just making it very clear, like, what are the circumstances in which these sanctions would be applied. Like, we will sanction under case X, but not under case Y, right? I mean, on the other hand, maybe you don't like doing it because that limits your flexibility. On the other hand, I mean, again, you go back to like, how do you motivate countries to think that their risk is not that high? Well, I mean, you have to kind of be willing to constrain your hands a little bit, right? So that's I think the U.S. implication. I mean, obviously for other countries, and then the question is like, how do I come up with a reasonable estimate for what this risk is? Because the interesting thing is it's a setting where there's a lot of private information, right? Like I don't know this for sure, but my guess is that the central bank of Russia did not know that Putin was planning to invade Ukraine. I mean, there are a lot of senior Russian officials that were insisting that they weren't going to do it. I mean, of course, maybe they were lying. I mean, I don't know.
I've heard that. I think it was Nubela. I can't pronounce her name. Nubela. I don't think she knew.
Yeah. So if this is something where the sanctions are getting applied for actions that are being taken that are just way outside the purview of a central bank, so they're not going to know about it, then they have to come up with some way of, kind of estimating like what's the risk of that happening, which involves both, a very it will involve kind of making very honest assessments of both kind of their own domestic political processes and how those relate to those of the United States, and then maybe also to some extent like the incentives of other countries. So it's complicated.
Well, yeah, and even I think
Yeah,
even MBS,
yeah,
like he has his their SAMA, which is like the official central bank's kind of reserve sort of portfolio, and then there's the PIF, which is essentially a mortgage like more like his piggy bank. But he's redirected a lot of the flows from Aramco into PIF away from SAMA. It's like he sort of started to like personalize those national reserve holdings, and PIF has done lots of investments in lots of things. Like I think I'm not sure if it was PIF or something affiliated with PIF that spent $400 million on this fake Da Vinci. He's like major investors in Western assets, equities, etc. It's like so for me, but like in terms of like where like a sovereign affiliated entity would dip into Bitcoin, it'd probably be more those like, and you tell me if you agree, but it'd be more likely to be those sorts of affiliated sovereign wealth funds that are arm's length necessarily from the central bank, and they can do it more covertly, but still using sort of national assets to diversify.
yeah. That's right. And then also just because for a sovereign wealth funds are basically not required to disclose anything.
Mm-hmm.
Just maybe to reassure their citizens of something, they would typically publish some kind of annual report or something. But in an annual report, they don't have to really. If they're making a relatively small investment in Bitcoin, it could just get wrapped up in their annual, returns or whatever, and they don't even really need to comment on it. So, no, I think that's right. Whereas, like for official central bank reserves, there are disclosures. They're supposed to send accurate information to the IMF. Yeah, and that gets all wrapped up in like the international balance of payments and so forth. So. No, I think that's right. Thinking about like what's the right vehicle for owning Bitcoin, that's also a consideration.
So you've written this paper. Obviously, it's caused a little bit of a buzz. In terms of you thinking about these questions, seriously, professionally, analytically, like what do you think is like unexplored territory, or where would you take it next? You might mention that you're revising the paper. Kind of what are those pieces that you think need to be added?
Yeah, well, so I had said that you can always do more sensitivity robustness text, right? Like writing a big long appendix, and looking at kind of to change some of these variables, like how much do my answers change? That's always important to do. Moving beyond that, I think having moving this into kind of more of a general equilibrium framework where you're actually getting at that question of like how much does the interest rate on treasuries change with respect to the risk of sanctions? Because you're going to motivate foreign buyers or foreign countries to reallocate their reserves. If they're going to sell treasuries because of the risk of sanctions, they're going to sell them to somebody who's going to demand a higher interest rate for holding them. And so like thinking about like how much that those interest rates could move around. I think this model would be a part of that, and it would be an interesting paper to write.
Awesome. Well, I'm excited to read that whenever you get time. So appreciate having this conversation. So obviously, maybe we'll be able to see some of this on the btcpolicy.org website. I know we're happy to have you kind of help contribute to some of this analysis, but on your own kind of professional domain, where's the best place for people to kind of keep track of this work and see any updates?
Yeah, so I have a Google website where I've got one of the pages is research, and I intend to keep that updated with links to my papers, whatever the current version of them is, as well as like if there's an online appendix or something, I'll probably put it there. It's nice because it's a permanent website. It's not connected to a university. So like once I graduate, I won't necessarily have access to all of Harvard's like website infrastructure. So it's so that'll be, I intend for that to remain and be a permanent kind of repository for research.
Awesome. Well, I'm sure there'll be a lot of folks that want to keep updated on that sort of work. So with that, thanks, Matt. The Matt's here. Maybe we'll do this again sometime. I feel like we could keep talking about this stuff for hours and hours. But for now, I think we'll call it a day.
Yeah, thanks, Matt.
Awesome.